Are you dollar cost averaging into the S&P 500 and hoping it will work long term? I mean, don't get me wrong, I am all for investing. In fact, I would rather that you dollar cost average than do nothing, because investing that way is still much better than holding cash. But here is the hard truth. Dollar cost averaging doesn't manage risk. And when the market tanks, it will take you with it. But of course, today we have so many tools at our disposal that we can easily beat buy and hold and dollar cost averaging. And everybody should be into that. First of all, let's define dollar cost averaging. Basically, you start to invest in an index like the S&P 500, and every month you deposit a fixed amount of money into that index. So basically you are buying every month, and over the long term, you're averaging your cost when the index is up and the index is down. Now, theoretically, this makes a lot of sense because you don't need to worry about if the market is up or the market is down. You're just going to buy every single month. And on paper, this should reduce your drawdown, because when the market is tanking, you are still buying and you're averaging your cost. And theoretically, again, it's much better than buy and hold, which of course is true. But theoretically, it should manage your risk, and that is false. This is a monthly chart of the S&P 500. And these are drawdowns denoted with the red, and the green part is how long it took to recover. And you can see the S&P 500 is filled with drawdowns, and with drawdowns within a drawdown. And actually, I have an article on my website. So if you go to Study Oasis and articles and search for S&P 500 drawdowns, I really discussed this in length. And you can see these are the duration in years. And I know this looks far away, but this is not too far. So in the year 2000, the drawdown took 13.28 years to recover. And in 2007, it took 5.5 years to recover from that drawdown, and so on and so forth. And they come in all shapes and sizes. Also, this is only the S&P 500. So here is the Japanese index, and you can see the Japanese, this is also a monthly chart. You can see that since December of 89, we actually didn't recover. We are still underwater. So that's more than 34 years of the index underwater. Now, okay, theoretically, you are buying every month, so your cost should be, I don't know, somewhere around here. We don't know unless we test. And that's what I will do in this video. I will test the buy and hold dollar cost average and a simple system. And the system that I'm going to show you is not the best, but the criteria that made me build it is, first of all, we have no software, so anybody can do it on any chart. And it should trade monthly because, like the dollar cost average, you're investing monthly. And it should outperform the dollar cost averaging or buy and hold. Now, the idea for this video came from this comment. So this guy hates Diet Pepsi. So he mentioned that the indexes tend to drift up all the time because of the way they are built, which is true. But this I don't agree with. That's why dollar cost averaging works great for these indexes, because the object is to reduce the drawdown. So the best portfolios to beat these dollar cost averaging or buy and hold are tactical allocation portfolios. Of course, I have many of them on my website, you can see, but in today's video, we will build a simple one. So we will use a moving average to get into the asset. The system is extremely simple. If the price is above the moving average at the end of the month, we get into the market. And if the price is below the moving average at the end of the month, we get out of the market. During the month, we don't care what happens. So just like dollar cost averaging, you don't care about the drawdown. You hope that you're averaging the cost and you are getting rid of the drawdown. Of course, you cannot get rid of it, but let's say you are mitigating that risk. And so this system is the same thing. You're only concerned at the end of the month to either buy more or exit. So here is the test. Since 1985, we are going to use the SPY, which is the ETF for the S&P 500. And we are starting with $10,000. So our simple moving average look back period is 12 months. So when the price is above it, we buy, there's no stop loss, and we are trading on monthly signals. And when the price is below it, we exit. Now the buy and hold is buying since the beginning, and that's it. So let's run this test. These are the results. Our model produced $243,000. The buy and hold, $224,000. About very close compound annual growth rate. But this is it. Like the drawdown here is 50%. Remember, this is measuring the drawdown on the monthly signal. And our drawdown here is 16.6. Now you might be wondering, this is not dollar cost averaging. And of course, I know. I just want to show you also that the buy and hold also doesn't hold ground with a simple system. Okay, now to turn this system into dollar cost averaging, we add cash flow. So we will contribute a fixed amount, and this could be any amount. So I'll put $1,000, and the amount will be contributed monthly. So every month we will add $1,000. I also added inflation adjusted, meaning that this amount will increase as per inflation. This keeps it more practical because let's assume you start today. In 10 years, that $1,000 doesn't matter anymore. So if you are always adjusting it with inflation, then the contribution will matter. Okay, and now we test. And this time we make more money with the buy and hold. Now the buy and hold portfolio, by the way, it's dollar cost averaging, because now it's every month is investing in the index. And at the first glance, you see that, well, it is making more money. This is 2.7 million. This is 3.1 million. But remember, it's about managing risk. So the compound annual growth rate is, again, is the same, 2020. But the standard deviation, this is about 11, this is 15, which of course translate into the maximum drawdown. This is 46 and this is 15.6. So this 46 including the dollar cost averaging. And this what shows us that the dollar cost averaging doesn't manage risk, because we are still facing 46.5% drawdown. And these are the drawdowns. This is our model, the tactical asset allocation model, and this is the dollar cost average. And we can see the divergence in the dot-com crash. It's about 6%. Here is 45%. Subprime 2008 is about 5%. Here is 50%. And recently in COVID, this is 8% and this is 20%. Also, we notice that the difference in recovery, the longest here is 2 years underwater. That means it took 2 years from the beginning of the drawdown till we recover. And here we have 6 years and 3 months. And if we look at the rolling returns, this compares our model with the dollar cost average. And basically, after any 3-year period, we expect the lowest to be, let's say, around 0%. And at 5 years, about 1.8%. That means if you enter this trading system at any point in time, after 5 years, the minimum you are achieving 1.8% and the maximum is 25%. While for the dollar cost average, you need 15 years to reach positivity. So at any time you can enter the market, you expect to be positive after 15 years, while it's 5 years within the system. And this is again about managing risk. And like I mentioned, the system is only trading the S&P 500. Of course, you can trade multiple assets. So for example, let me show you quad edge momentum. So this portfolio applies the same principles, but now trades multiple assets, including the S&P 500. And here is the stats compared to the benchmark, which is the 60% S&P 500, 40% IEF, which are the long-term bonds. The takeaway here is in today's environment, we can easily beat the buy and hold or the dollar cost averaging. It's not like before, because Now we can test system like these going back to 1970. In fact, the quad edge that I just showed you, the test is since 1970. So you have 50 years to look at. And of course, there are systems that have been tested for 100 years, 120 years, and they still perform. Momentum will always beat any type of system long term. If you like this video, then you will love the next one.